In this video, I'm going to give you an extremely realistic game plan to get from $0 to 1 million in just 5 years. I'm going to assume that you have a W-2 job, are roughly 22, and have limited capital coming straight out of college. We're going to get you from $0 to $1 million in just 3 deals. Deal 1, you're broke and you have no skills. Everyone was here at some point. I certainly was too. You can either whine about it or you can get moving. You should be looking at for your first deal following a simple 3-step process. Step 1, figure out what deal size to target. Step 2, find the deal. Step 3, pull the trigger. Most people think making money is hard because they focus on how hard the end goal is, in this case, making $1 million, instead of focusing on the first step of the process, getting the knowledge necessary to start making money. The first deal doesn't matter at all. Right? The only reason that matters is to get you in the game. Once you buy a deal, you start accruing market knowledge, you start accruing relationships, investor relationships, lender relationships, broker relationships. That's when you start making real money. So what does this mean in a practical sense? For your first deal, you should be targeting a deal in the 1 to 5 unit range, $200K to $500K purchase price. Deal 1 should look something like this. Like I said above, the first step is figuring out what deal size to target. And in order to do that, you have to know how much equity you have to put into the deal. Typically, you have 2 options. Option 1, put in your own money. Option 2, use other people's money. If you're using your own money, the answer is simple. Look at how much capital you have, then multiply that number by 4 to account for debt, and that's roughly 75% leverage, and that gives you your number. So if you have 100K to invest, you could take down roughly a 400K deal. If you don't have a lot of money yourself, you're going to have to raise that from investors. That's fine. I did my first deal with just $2,500 of my own money and raised money for it, so it's not a big issue. But whatever amount you can raise back into a deal that size using the same formula just used above. Now, what if you can't raise any money? I get this question a lot. The way I look at it, first off, it's probably a severe character flaw if no one you've ever met in your entire 20 plus years of life will give you any money, but that's kind of a separate point. But if you truly can't raise any money, what I would do is I would start up a real estate related social media account, share your thoughts, share your analysis, and create a network and raise money that way. I know this is possible because I've done it. My Twitter account has 115,000 followers. And if I wanted to raise money in there, I could do it extremely easily. So now that we know what deal size to target, that gets us to step 2, finding the deal. In order to find a deal, you need to pick a market. There are tons of ways of doing this, but I'm going to make it really simple. We're going to go into a market where deals sell for less than 150K a unit and sell for at least a 6% cap rate minimum. Otherwise, the market's likely too competitive. If you're looking in the 500K and below range, that means you're going to search on Zillow and Redfin for duplexes, triplexes, and quads. If you're looking in the 500K and above range, you'll be using LoopNet and Crexy. Go on those sites, do some research, and find a market that satisfies that criteria. Now that you have your market, you need to get a lay of the land. Open up Excel, make a list of every property listed for sale on the market, track the price per unit it's listed for, and note the price per unit it sells for when it sells. You want as much data as possible, so download any and all financial information that's included in the listing. If there's no information in the listing, call up the broker and get it directly from him. By the end of the process, you should know exactly what price per unit properties sell for in the market and exactly what cap rate they trade at. You'll be looking to buy a property below the market price per unit and above the market cap rate, the stabilized yield. Simple. The next thing you need to do if you want to buy a property is to get the information necessary to build a profit and loss statement. A profit and loss statement is basically just revenue minus expenses. It allows you to underwrite and value a property. Going from top to bottom, you want to start out with revenue, which is driven by the market rents. There are 4 main places you can get market rent comps from: brokers, MLS/CoStar if you have access to it, and Zillow and Apartments.com for active comps. Some of those will actually cost money, like MLS and CoStar. Everything else is totally free and available to you. Once you get these comps, put them all in Excel. You should try and get as many as you can. Discard any outliers and take the average. You'll need to run the market rent for each new deal you look at, as each property differs slightly, but this should really get you very close initially. Now for the expenses. Remember all the P&L information you downloaded from each listing? Now is when it comes in handy. Line each property P&L up next to each other in Excel, and for each individual line item, note the cost per unit, cost per square foot, and the overall expense load as a percent of revenue. This should be incredibly comprehensive. You now have the exact expenses necessary to run a property in the market. So at this point, you figured out both revenue and expenses, which allows you to create a brand new P&L for new properties you look at from scratch. That allows you to underwrite new deals you come across extremely easily and allows you to start actually looking to get a deal to buy.
Now you know how to underwrite a deal. You just need deals to underwrite. Where do deals come from? Brokers. Go on the sites I listed before:
LoopNet, Crexi, Zillow, Redfin. And every time you see a broker on a listing, call them up, ask them a few questions about the deal, get them comfortable with you and kind of get to know them, and then tell him your criteria and ask him to add you to his mailing list. Do this with as many brokers as possible. If you do this right, you should start receiving passive deal flow to your inbox every single morning. Right? But let's set some expectations. This is not a business where you look at 2 deals and find a home run deal. Just not how it works whatsoever. If you're lazy, if you're not willing to do any work, you're not going to make any money. On the other hand, if you put the work in, you'll probably start making a lot of money very quickly. So what I would say is you probably have to look at 50 deals or so before pulling the trigger. That means in the beginning, I would say you're going to underwrite 3 to 5 deals a week at minimum. You're going to underwrite them based on the stabilized yield. For those of you who don't know what that is, it's basically the NOI after all renovations and after all improvements to the property have been executed, divided by all your costs in the deal. So the purchase price, closing costs, renovation costs, reserves, etc. It's basically an extension of the cap rate that we talked about before. So you're going to look for 150 basis point plus spread between your stabilized yield and the market cap rate. So if the market cap rate is 6%, you're looking for a deal with a stabilized yield of 7.5% or higher. Higher the stabilized yield, the better. Higher the stabilized yield, the more money you make. The goal is to understand exactly what price per unit and stabilized yield you'd buy a property for in the market, because that gets you ready to pull the trigger when the time comes. Step 3, pulling the trigger. At this point, your buy box should already be established. The only thing left to do is find a deal that fits it. So as a reminder, what's your buy box? 1, your deal size, right? Available equity times 4. 2, your market that you picked out. 3, any submarkets you think are the best places to buy in the market. 4, making sure you're buying below the market average price per unit. 5, making sure the stabilized yield is 150 basis points above the market cap rate, at least. This is a very detailed list, right? You should be tracking the deal aggregation sites daily. You should have plenty of broker contacts, and you should have a lot of deal flow hitting your inbox. When you see a deal that fits your criteria, pull the trigger. One other thing to mention, since this is your first deal, you may have a hard time getting a loan. Instead of whining about this like most people do, there's a few options here. 1, you could do the deal all cash. 2, you can use seller financing. 3, you can get a guarantor to hop on the loan with you. Doesn't really matter which one you use, but just try and get the deal done as quickly as possible. So as a summary for deal 1, depending on your access to capital, your first deal should be 1 to 5 units in the 200K to 500K range. The timeline should be quick. Doesn't take long to renovate 5 units or less. The profit doesn't really matter, so I'm not even going to bother listing it, right? It's all about learning. And really not caring about the profit on deal 1 may seem funny in a post where we're saying, hey, let's get from $0 to $1 million in 5 years. But the real purpose in the beginning is education, right? You have to get that through your head. You learn how to make money and then you make the money, right? So most people want quick cash. They take 0 time to learn and they end up never making any money. The people who make a ton of money, they spend a year or 2 learning how to do it. And then there's a huge step up in income right afterward. So deal 2 is really where the fun starts. Deal 2. While you're stabilizing deal 1, you should be working on deal 2. It's not hard to operate a sub 5 unit property, which is deal 1, so you have plenty of time. The idea would be to close deal 2 within 18 months or so of closing deal 1. And this is a very realistic timeline. I know I've done this myself, so it's extremely realistic. Deal 2 is different, right? You're no longer a beginner, and this makes life a lot easier. You've already established your market, you know your buy box, you have lender relationships and broker relationships. The only thing that's changing is the deal size, which should now be bigger. And this is really the big mistake people make. Instead of scaling up after deal 1, they do a similar size deal, right? They stay in their comfort zone and they kind of get scared of getting bigger. And this is really the opposite of what you want to do, right? Just because you bought 1 triplex doesn't mean you need to buy another triplex, right? In reality, you need to get bigger to make more money. And that doesn't always exist. At a certain point, you cap out, but in the beginning, it does. Next deal should be in the 10 to 20 unit range. Let's call it $500K to $2.5 million size range. Timeline should be roughly 18 months, once again, and your personal profit should be between 38K and 188K. Honestly, I think this is a very low bar, but we'll go with it anyway. In reality, on a deal this small, you can definitely beat a 2x return, which you'll see in a second. So how does it work? You're going to buy another value add multifamily deal using the same process laid out above. In this case, you want your stabilized yield 200 basis points plus above the market cap rate, which gets you to roughly a 2x return. Let's say you buy a $2.5 million deal, 75% debt, 25% equity. You don't have to syndicate the equity out in this deal, but I'm going to assume you're still capital constrained and that you need to. So 2.5 million times 25% is 625K of total equity. You're only putting in, let's call it 5 to 10% of the equity yourself, which is between 30 and 60K, depending on your preference. So that should be very doable. I'll assume you're able to 2x the equity of the deal again over the course of 18 months. So this should be very doable. 2x would be at 625K in profit. And since you syndicated the deal, I'm going to assume you charged a 30% promote, which is pretty typical, 20 to 30%. That means you're entitled to 30% of the profits, even though you only put in 5 to 10% of the equity. So 625K times 30% is 188K. Not bad for 18 months of work. You also obviously get your initial capital back, which really gives you a decent chunk of change to invest in your next deal. And at this point, I would say you're still just getting started. Deal 3. At this point, you really have the hang of things. You have 2 successful deals under your belt, and the learning is mostly over. You spent 3 years making pretty much nothing while banging your head against the wall, and now you're looking to make real money. You should have an edge in the market right now, right? You have accrued market knowledge and relationships, and you should be ready to take advantage of it. So you're going to scale up again. This time, you're going to look for a deal in the 50 to 100 unit range and the 2.5 million to 12.5 million size range. At risk of sounding repetitive, you're going to use the exact same process that you used on the prior 2 deals, just on a slightly larger one. Same exact thing, the numbers are just bigger. But you've been developing a skill set for 3 years doing smaller deals, so it should make your life a lot easier. Some things will change this time around. On a deal this big, you might need a guarantor to help you out with getting a loan, which means giving up a piece of the promote. But the process of analyzing real estate remains the same. The process of buying real estate remains the same. And even the execution of the business plan remains exactly the same. You're going to look to kind of utilize your relationships that you've built over these 3 years to scoop up a deal off market. So we'll assume you're able to find a deal that stabilizes 200 basis points above the market cap rate. We'll assume you're able to execute your business plan and 2x your money again, right? This time in a 2-year span, so slightly longer, just because the deal's bigger. And once again, this is extremely realistic. I just exited a 50-unit deal in 22 months, so very realistic. So a $12.5 million deal, that's roughly 3.125 million of equity. Assuming you double your money on that, right? So you have a 3.125 million of profit. 30% promote gives you roughly $937,500. There it is, right? You basically made $1 million. So couple that with the 188K you made in the last deal, and you're actually over $1 million. So that's it. If I were 22 again, this is exactly what I'd do. 5 years, $1 million, millionaire by 27. Is any of this easy? Of course not. No one's going to hand you a 2x return, but it's all extremely realistic. Each step follows the next. As long as you proceed methodically, one deal at a time, it's very achievable. And actually, if you take a step back and really look at the plan, it's only 3 deals in 5 years. I wouldn't be surprised if many of you were actually able to outperform that. And if anyone tells you it's not possible, they're just flat out lying to you. Making money off real estate is what I do for a living. Some of my other videos actually show examples of real deals I've done. You can check that out on my channel. And if you want to learn more about how I do it, you can apply to the Acquisitions Bootcamp in the description below. You'll learn how to analyze, find, and buy profitable deals in just 8 weeks. I can confidently say 0 other programs like it exist on the internet. And as you can see from these case studies, the results have been insanely good.